What's up, you guys? Welcome back to the Options Income Strategies channel. In this video, I'm going to talk about a strategy where if you missed out on a rally on a particular stock, how can you keep making a profit while the stock is still going up or it's going down and you're not really sure when you should buy the stock. So, as an example, I'm going to talk about Zoom Video Communications, which, if you've been following the stock over the last few months, it has nearly tripled in the since its IPO at $65. Now, if you didn't already own stocks of it, and now the stock is already trading at say $150, $160 a share, you might think, okay, it keeps going up, and it's benefiting from the current lockdown and people working from home, so maybe I should buy shares. But at that point, if the price starts going down, you don't really know what to do. You might think, okay, it's peak, now it's just going down. You might sell your shares at a loss. But I'm going to suggest a strategy right now where you can keep making profit whether the stock keeps going up or goes down a little bit. And when it's come down as much as you really want, where you think it's fairly valued, only then you start purchasing it. Okay? So let's go to the zooms. And so the strategy is called put credit spread. Okay? And let's go to Zoom stock and see the strategy that I implemented. So about a month ago, when the stock was still trading at $149, I really wanted to buy more shares. I wasn't sure if I should sell out or not. I did purchase a few, but in case the price started going down, I wanted to see if I could lock in some profits using what is called a put credit spread. So here's what I did. So I purchased $420 put options that are expiring on June 19th, and I sold for put options with a strike price of $125 that are expiring on June 19th. This is what is called a put credit spread, where you purchase a put that is at a lower strike price than the put that you sold. And because of this, I got a credit of $560. Now, as I started following the stock, see, on April 20th, it was $149. And as I kept following the stock, I realized, oh, wait a minute, it's dropping down really quickly, and now it's at $135. The put credit spread that I had before, it was going to expire on $123. And just in case this kept going down, that's when you need to adjust your risk so that you don't, so that you can avoid a loss. That's how you manage risk that I talked about in the previous video. So what I did was, so I sold out of the $120 put that I purchased before, and I bought back the $125 put that I sold before. And instead, I replaced it with the $105 put that I bought and sold a $115 put. So what this essentially did is it brought down the break-even price from $123 that it was previously to only $109. Okay, and for doing that, I actually got an additional credit of $320. So adding that to the $560 that I got previously, now I am at a total of $880 in credit. Now, I wasn't sure if that would be enough. I wasn't sure if the price will keep going down or not. So what I decided to do is I figured, how about I bring down the break-even price even more? So now I reversed those trades that I was talking about before and decided to purchase the $95 put and sold a $105 put. So now my break-even price is only $99, and I got an additional credit of $160. So if I add that to the $880 before, now I got a total credit of $1,040 to make sure that the Zoom price will not go down before $99. Now, if you look at the current share price, it's at $144.60. So the stock has to drop 50% in the next 6 weeks for me to lose any money on this. If it doesn't, then my put credit spread will still be valid and I'll get to keep the entire $1,040 credit. So if you look at the options right now, in just the last 2 weeks, it returned $440. What that basically means is the initial credit that I had is actually the current value of that credit keeps going down, which means I get to keep that additional credit. Once this credit expires worthless, I'll get to keep the full 100% profit and the full credit that I initially got. Okay, so that's what I wanted to share with you today on how you can use put credit spreads to hedge your bets against the stock, where if the price is going to keep rallying, you'll keep your initial profit. If the price goes down a little, then you'll still keep your profit. And if the price really starts dropping, then you can reverse your trades, lower your put credit spread to get a lower break-even price, and you'll keep the full credit that you initially bought. Okay, and once it's down low enough where you think it's now fair value and it's a good entry point, you can actually completely close your options and really start buying shares. Okay, hit the like button, it'll really help the channel. Subscribe and leave any comments or thoughts below. Okay, thank you and take care.